Let's look at the past picks now from David Burrows. He's president of Barometer Capital Management. And you made these selections on my mother's birthday, by the way, last year, January 25th. And we're looking at Caterpillar. You recommended just under $95. It's up 3% since then. It was up a lot after that, but you got out of this a long time ago. Why was that?
We went through a big shift in our portfolio in the spring of last year. Market started to roll over. We got quite concerned about economic growth, and we moved out of a lot of cyclicals. And at that time, we were really heavily rotating into yield-oriented names. And so this one was one that came out of the portfolio. And arguably, I think that it is still not time to be focused on the machinery stocks. You know, a lot of people don't talk about this, but there was a big tax break last year for capital investment by American corporations. And it brought a lot of capital investment forward. And the products had to be purchased and delivered by the end of the year. Now, Caterpillar has a very long pipeline of deals, but I think in general, machinery companies may underperform this year because companies probably will cut back a little bit on capital expenditure. And we think it's going to be the companies that were spending money last year and maybe cutting back on the spending that do better this year.
All right, IBM, you recommended at $161. It's up 17% or 16%, and you're still holding this one. Tell us about IBM.
Yeah, so IBM was really the first of the big cap tech stocks to break out. And, you know, we talked about this a year ago that, you know, the company earned about $2 in 2000, sorry, $1 in 2002. It's going to earn $13.50 or so this year. So it's been a huge ramp up in earnings. And over that 10-year period, you know, the earnings multiple got compressed as people fell out of love with technology companies. And IBM has a very strong recurring revenue base. They've got a very strong services business, and it's been a real leader. Now, we have recently come out of IBM in favor of a couple of other large technology companies.
It completely?
So we are out of the position today. Frankly, if I had to initiate a large cap tech name today, and we don't own it yet, but looking hard at it, I'd probably be inclined to move towards a Microsoft because they've got lots of catalysts coming over the next year and a strong dividend and one that can grow.
We had a guest on earlier who liked Microsoft as well. And up in Canada, you recommended a Riocan REIT at just over $23, up 20%. You still hold it. Here's one of these cash flow generators with a yield.
Yeah, so REITs make up in the income portfolio about 20% of the portfolio. On average, they're over 99% occupied. And we think for the shopping center REITs, it's going to be a good year because you got a bunch of a few U.S. retailers coming to the Canadian market. It's a pretty fully occupied market as it is, so there's going to be some pricing power and rents are going to go up.
You mentioned market leaders. Just quickly, which stocks are really impressing you right now as far as breaking out and leading the way? IBM and who else?
Well, I mean, if you look at, there's a few themes, okay? Telecom has been a theme for a while, and that's one that we're focused in. Midstream energy assets, the pharma stocks, but very large cap companies. If you look at the equal weighted S&P, it's underperforming.
All right, save that thought. We'll get back to that. More with David Burrows right after this.